Question 471. A historical society hires appraiser Andrew to gauge the value of its majestic domed meeting house, built in 1876. In applying the cost method of appraisal, Andrew is most likely to use the building's A. Reproduction cost, B. Replacement cost, C. Both A and B. D. None of the above. Correct answer is B. Replacement cost. Replacement cost is the current cost of building a property with utilities equal to the subject property, i.e. a building usable in the same way as the subject property. Reproduction cost relates to what it would cost to build an exact duplicate of the subject property at current prices. If the subject property is a new home, then reproduction cost and replacement cost may be the same. If, as in this case, the building is older and was elaborately constructed with expensive materials, reproduction cost is an unreliable indicator of value. Question 472. In order to be valid, a trust deed must include a provision requiring the trustor to A. Keep the property in good repair, B. Maintain insurance for property, C. Remain current on all tax and assessment payments for the property, D. None of the above. Correct answer is D. None of the above. A trust deed typically includes 1. Identification of the parties involved, trustor, beneficiary, trustee. 2. Description of the property. 3. Loan amount and repayment terms. 4. Conditions of default, events that could trigger foreclosure. 5. Assignment of title, how title is held during the loan term. A trust deed serves as a security instrument for the lender. It doesn't generally dictate the borrower's maintenance or financial obligations related to the property. These responsibilities might be outlined elsewhere, such as in loan agreements or separate disclosures. Question 473. Which of the following most closely resembles the relationship between a seller and a broker? A. Broker and salesman, B. Trustee and beneficiary, C. Mortgager and mortgagee, D. Vendor and vendee. Correct answer is B. Trustee and beneficiary. The broker acts as the seller's agent, owing them fiduciary duties of loyalty, obedience, disclosure, confidentiality, accounting, and reasonable care. The trustee acts as an agent managing assets for the benefit of the beneficiary, also bound by strict fiduciary duties to act in the beneficiary's best interests. While the broker-salesman relationship, A, involves an agent acting for a principal, the broker. It's more of an employer-employee or independent contractor dynamic, and the fiduciary duties are ultimately owed to the seller, the broker's principal. Mortgager and mortgagee, C, is a debtor-creditor relationship with the property as security. It's lacking the same agency and fiduciary responsibilities aimed at representing the principal's best interests in a transaction. Vendor and vendee, D, are the two principals in a sale, acting in their own self-interest, albeit hopefully reaching a mutually agreeable transaction. Rather than one acting as an agent with fiduciary duties towards the other in the same way a broker acts for a seller or a trustee acts for a beneficiary. Therefore, considering the core element of a fiduciary duty where one party acts in the best interest of another, the trustee-beneficiary relationship, B, does indeed closely resemble the broker-seller relationship. Question 474. The major differences between the exclusive authorization and right to sell listing and the exclusive agency listing is, are, A. With the exclusive agency listing, the broker is entitled to a commission even if the owner sells the property himself. B. With an exclusive authorization and right to sell listing, the broker is entitled to a commission even if the owner sells the property himself. C. With the exclusive agency listing, the broker is not entitled to a commission if the owner sells the property himself. D. Both B and C. Correct answer is D, both B and C. 1. Exclusive authorization and right to sell listing. Under this type of listing agreement, the broker is entitled to a commission regardless of who sells the property during the listing period. This means even if the owner finds a buyer on their own, the broker is still owed a commission. 2. Exclusive agency listing. With this type of listing agreement, the broker is entitled to a commission if they or any other broker find a buyer for the property. However, if the owner finds a buyer themselves without the broker's assistance, the broker is not entitled to a commission. Therefore, the correct answer is D, both B and C. Question 475. Which is the most accurate definition of a fee simple absolute? A. An estate for life. B. Highest and most complete type of land ownership. C. Estate for years. D. Defeasible fee. Correct answer is B. Highest and most complete type of land ownership. Estate for life grants someone the right to possess and use a property for their lifetime, or the lifetime of another designated person. A fee simple absolute conveys complete ownership, not limited to a lifespan. Estate for years refers to ownership for a specific period, like a lease agreement. A fee simple absolute grants ownership in perpetuity, forever. Defeasible fee is a type of ownership with conditions that could cause the estate to revert to the grantor or another party if specific events occur. A fee simple absolute has no such limitations. A fee simple absolute represents absolute ownership of land, so the owner may do whatever she chooses with the land. When an owner of a fee simple dies without a will, the land descends to the heirs. Question 476. To establish an agency relationship between a principal and broker, the most important component is the A. Offer. B. Property description. C. Commission agreement. D. Written employment contract. Correct answer is D. Written employment contract. In many jurisdictions, including California, the statute of frauds requires agreements authorizing an agent to sell real estate for a commission to be in writing to be legally enforceable. This means that an oral agreement to pay a broker a commission for selling property is generally not legally binding. A written contract clearly outlines the scope of the broker's duties, the specific property involved, the terms of the commission, the duration of the agency, and other essential aspects of the relationship. This minimizes misunderstandings and potential disputes between the principal and the broker. Without a written agreement that complies with the statute of frauds, a broker may not be able to legally claim a commission, even if they successfully procure a buyer for the seller. The initial offer and acceptance are the foundational elements of any agency relationship. But the written employment contract is the crucial component for establishing a legally enforceable principal-broker relationship in real estate, particularly concerning the broker's right to compensation. Question 477. An arrangement that allows a mortgagor to borrow additional sums in the future up to a maximum amount, secured by the mortgaged property, is called an A. Assumed loan. B. Advance costs. C. Open-end mortgage. D. Secured future mortgage. Correct answer is C. Open-end mortgage. Assumed loan occurs when a buyer takes over the existing mortgage of the seller. It doesn't involve borrowing additional funds in the future by the original mortgagor. Advance costs are expenses paid up front when obtaining a mortgage, such as appraisal fees or credit report fees. They don't relate to future borrowing. While secured future mortgage accurately describes the concept of borrowing more against an already mortgaged property, the industry standard and widely recognized term for this financial arrangement is an open-end mortgage. Open-end mortgage allows the borrower to reborrow principal that has been repaid, up to a certain credit limit. It's similar to a line of credit secured by the property. As the borrower pays down the principal, that amount becomes available again for future borrowing without having to refinance the entire loan. Home equity lines of credit, HELOCs, are a common example of an open-end mortgage. It allows for re-borrowing whenever required, without negotiating a new mortgage. The interest rate applied is the usual market interest rate, which rises and falls based on market conditions. Question 478. May place a limitation, called a restriction, on the use of a property. A. A private owner. B. A developer. C. The government. D. All of the above. Correct answer is D. All of the above. Restrictions are generally placed on property to make sure that land use is uniform and stable within a particular area. When selling or transferring property, a private owner can place restrictions on its future use through deed restrictions or covenants, conditions, and restrictions. CC&Rs. Developers often create and record CC&Rs for entire subdivisions or planned communities to maintain property values and standards within the development. These restrictions govern how owners can use their land. Federal, state, and local governments can place limitations on property use through zoning ordinances, environmental regulations, building codes, and historic preservation laws. Therefore, private owners, developers, and the government all have the authority to place restrictions on the use of a property. CC&Rs are a legally binding set of rules and regulations that govern how homeowners can use, maintain, and improve their properties. These rules are typically created by the developer of the community and are recorded with the county. When you purchase a property subject to CC&Rs, you automatically agree to abide by them. CC&Rs aim to maintain property values, ensure a certain level of aesthetic consistency, and promote a harmonious living environment within the community. They can cover a wide range of aspects, such as architectural standards, landscaping requirements, restrictions on pets, parking regulations, and the use of common areas. Question 479. Conveying an interest in real property through the terms of a lease is called a term interest. B. Tenancy transfer. C. Lease. D. Severalty. Correct answer is C. Lease. A lease is a contractual agreement by which one party, the landlord or lessor, conveys possession and use of real property to another party, the tenant or lessee, for a specified period and for a specified consideration, rent. This conveyance creates a leasehold interest in the property for the tenant. While a lease creates an interest for a specific term, term interest is not the standard legal term for the act of conveying that interest. Tenancy transfer generally refers to the assignment or subletting of a tenant's existing leasehold interest to another party, not the initial conveyance from the landlord. Severalty refers to sole ownership of real property by one individual or entity. It's the opposite of shared ownership and doesn't relate to conveying an interest through a lease. Question 480. John is opening a new restaurant in a shopping mall, with no certainty about how much income it will generate in its first year. The type of lease offered by his landlord has the tenant paying a percentage of the gross monthly income added to a basic rent amount, called the A. Net lease. B. Percentage lease. C. Graduated lease. D. Ground lease. Correct answer is B. Percentage lease. In a net lease, the tenant pays a base rent plus some or all of the property's operating expenses, such as property taxes, insurance, and maintenance. A graduated lease has rent payments that increase at predetermined intervals over the lease term. A ground lease is a long-term lease of land, where the tenant typically builds their own structure on the leased land. Percentage lease is type of lease common for retail businesses, especially in locations like shopping malls where the landlord wants to share in the tenant's success. The rent is structured with a fixed base amount plus a percentage of the tenant's gross sales or income.